In the future, lower equity returns could be in the cards. That means the role of dividends will no doubt become an important component, maybe even a forgotten component that will be rediscovered in future returns. In the ETF market, funds focused on dividend income is still one of the largest categories by both assets and just sheer choice. Today's audience requested triple headers between dividend ETFs from Blackrock, Charles Schwab, and State Street Global Advisors. It's a heavyweight dividend ETF bout. Stick around. A cordial welcome to all. You're watching ETF Battles, and here we are in Season 6. I'm Ron DeLegge, the chief culprit of this madness, and if you'd like to send us an ETF battle request, I encourage you to do that. Do so in the comment section below. Send us your ETF ticker symbols. We could do double, triple, and quadruple headers. You can also hit us up on our X feed at ETF Guide. Also, be sure to check out our Season 6 playlist to make sure that the ETF battle requests that you're making are for contests that we have not yet already done. Also, visit the description section below. I've got links to our program judges along with our program sponsor direction. So don't be a stranger. We've also got viewer resources with download links to free audio and ebooks and other goodies. So again, hit that description section below. So today's heavyweight triple header dividend ETF bout was requested by a viewer named Sandip, and he submitted this to us on our X feed. It's between dividend ETFs from BlackRock, Charles Schwab, and State Street Global, DIVB, SCHD, and SPDG. Boy, this looks like a good one. Thank you so much, Sandip, for this ETF request. Helping us to sort through the clutter is a duo extraordinaire. We've got Tony Dong with ETF Central joining us, as well as Mike Akins at ETF Action. Judges, great to see you again.
Good to be back, Ron.
Thanks for having me.
So our 4 battle categories are cost, exposure, strategy. We've got performance and yield combined. And then we've got our mystery category where you, our judges, can shock us with that factor or thing that you feel is crucial to today's contest. Our judges can also nominate wildcard ETFs. If they like something else, somewhere else better, they can also opt for split decisions. It's entirely up to them. I've got the scorekeeping duties, and at the end of the program, we will declare an overall winner. Always keep in mind that none of the battle outcomes on this program are ever predetermined or known in advance by myself or our judges. So let's kick things off with the first category, cost. Tony, please get us started.
So all 3 of these are low-cost index tracking products. They belong to, for iShares, the core lineup, and for State Street, the portfolio lineup, whereas SCHD, well, most Schwab ETFs are cheap. So DIVB and SPDG both charge 5 basis points, and SCHD charges 6. In terms of spread, SCHD has the lowest one with DIVB in the middle and SPDG on the higher end. It's not as traded frequently, even though the underlying is fairly liquid. When you put the two together, it's pretty much DIVB that ekes out the others. But I want to stress that it's by a very, very slim margin. And all 3 of these are so cheap that unless you have like 7 figures in them, I really wouldn't worry about expenses here.
Mike, you're up next. How do you see it when it comes to cost?
Yeah, I'd even say 8 figures. It's that close. I mean, we're talking nothing. 5 basis points and 6 basis points expense ratios is what makes me love the ETF marketplace, right? You're getting diversified exposure to a lot of great companies in a tax efficient way for almost nothing. It's fabulous. It's why the ETFs are taking over the world, and I love to see it. So I don't really have much to add. Tony did a great job explaining it. Just keep in mind with SPDG, newer, little less AUM, therefore a little less volume. Spreads are pretty tight. Doesn't surprise me coming from a great provider like State Street, but you need to be a little bit careful or trading that strategy because you could run into some liquidity issues, get a bad execution, and then of course your expense ratio, your total cost goes up quite a bit. That's all I got. Oh, a winner? Can't do it between DIVB and SCHD. I'll just call it a toss up.
All right, that takes us next to exposure strategy. Mike, you're still up, so break it down for us.
Wow. So just exposure-wise, these three products are incredibly close. They look a lot alike when you break it down by market capitalization, when you break it down by size and style, even sectors, pretty close across the board. Strategy wise, you really have three kind of unique ways to go about it. SPDG is going in there and it's looking for yield on a sector by sector basis, and it's going to select companies that have a higher yield than the kind of mean yield of each sector. And then it's going to weight in a neutral component to the S&P 500. So what's great about that is a lot of times dividend strategies, you can get really overweight defensive. And as we know, the market itself is really overweight growth, whether it's tech or what have it, consumer discretionary. So that's going to give you a more market-like return with a little bit more yield. DIVB is, again, it's a very core product. They call it Dividend Core for a reason, because it's market cap weighted. So they're going in there and looking for the yield products, but then market cap weighting it, which gets it to look a little bit more like the market. Schwab is the one that's going to use the most fundamentals here. And historically, that's done really well for it up until this last year. We kind of had a rollover in some of those quality factors, and I'll get into that in performance. But Schwab's taking in a number of factors, thinking about quality of the balance sheet and then going after yield after that. From a pure dividend play here, and thinking about why you use dividends, and I think of dividends being used to provide mature companies that can provide a consistent dividend, you traditionally have strong balance sheets. And then that extra yield is going to reward an investor over time, kind of that value tilt. I give it to SCHD, even though it's had a tough run here over the last year. But I like all three strategies. But my winner is SCHD because it's more of a fundamental approach to it, whereas SPDG and DIVB are going to be a little bit more market cap centric.
Solid analysis. Thank you, Mike. Tony, you're up next. How do you see it between these three ETFs?
It's really going to depend on your views for sectors. So if you're the kind of person that is going to panic or worry when your dividend ETF diverges markedly from the market due to, like, as Mike mentioned, severe sector imbalances, SPDG is probably the best one. The sector neutral strategy means that this one is going to have approximately the same sector allocations as S&P 500. So there's overweights to financials, tech, communications. And of course, it's not just a pure yield play too. You have a screen that ensures at least 7 consecutive years of dividend payments or increases. DIVB is a little more complex. And I say that because its index has changed quite frequently. The last time was in December 2022. And what they did was that Morningstar placed a higher weight on dividends, so 75% and just 25% on buyback. So it used to be more balanced as a composite measure of shareholder yield, but they've de-emphasized buybacks. And in addition, they increased the universe for the highest yielding stocks to 50% instead of just from the top 90%. So what that did was that restricted it a lot less to just, the highest yielding ones. And another thing that they implemented that I do like is that they began excluding stocks with dividend yields in the top 5% of the market. And that's something that you see a lot of the top dividend ETFs do. And this just kind of gets rid of your yield traps very efficiently and simply. SCHD, on the other hand, is one of these very complex index ETFs that I like because they give you exposure to a very rigorous and systematically implemented strategy at a low cost. So, there's the 10 years of consecutive dividend payment screen, and then it gets weighted on 4 fundamental factors: free cash flow to total debt, return on equity, indicated dividend yield, and 5-year dividend growth rate. And then that gets pared down to 100 stocks. It reconstitutes every year. If I had to take a high-level overview of all three of them, I'm still going to go with SCHD just because I believe the index methodology is very solid. It's been executed consistently, and unlike DIVB, there hasn't been changes after the fact by the index provider. And then you can also go on their site and look at the methodology and the back test, and I think it's very sound, even though it had that hiccup. The one thing to note is that SCHD just reconstituted this year, and then we're seeing a lot higher weighting towards energy. And I think that's appropriate, just given the high free cash flow yield of that sector, the high dividend yields, and also the lower valuations. So SCHD all the way for me.
Very good. And just explain to our audience real quick, when you said reconstituted, some of our audience members may not be familiar with that. What does that mean?
So a reconstitution event is when the index basically goes through its criteria every year or every quarter to add and drop companies. So rebalancing is when they don't add or drop anything and they just reorganize what's in there according to the weighting methodology. But reconstitution is when you'll see new companies enter SCHD and old companies leave. And if you're interested in seeing what the ETF has added and what it's kicked out, you can find that usually on their webpage. There's an annual reconstitution report, and there's a variety of other analysts that will go in detail about what's changed. But this time we've seen that, compared to what happened last year, SCHD is less heavy in financials now, more heavy in energy. And I think personally that's a much better tilt.
Got it. Thank you for that added detail, Tony. That takes us next to performance and yield. And then we've got this combined, of course, being a dividend bout, we had to include yield. So Tony, you're still up. Break it down for us. How do these three ETFs compare?
Yeah, so the backtest is kind of limited by SPDG's newer inception, but from 2023 September to present, DIVB's done the best at a annualized 19.78 total return. SPDG's trailed slightly at 19.42, and SCHD has really lagged at 12.46. In terms of volatility, they're all same. Drawdowns are all very similar too. And this is, where you'll see the benefits of SPDG's approach when it comes to sector neutral. You're not making these big sector bets that can really derail your thesis. Instead, it's going to be up to security selection within the sector. And if you're a fan of the dividend growth and the dividend yield above the median screen, that's going to do well for you. Now, in terms of yield, DIVB is going to be the lowest. Ever since they updated that methodology in 2022, the yield's fallen just because the universe that they're selecting from isn't as high as yielding, and they got rid of that top 5%. On a 30-day SEC yield, you're getting 2.84 from DIVB. SCHD's yield has always been excellent. Right now, it's 3.71. But surprisingly, SPDG isn't that bad. I don't have it up right now, but I remember it's somewhere north of 3%. So to put it all together, I would say that historically, SCHD has kind of been a dog recently, but for the future, I am very much confident that on a total return basis, SCHD will do very well and better than the large cap pure category average. And I think the yield will continue to be good. It's actually increased significantly since this month last year around.
Excellent analysis. Thank you, Tony. And I also like the fact, too, that our judges, when considering performance and yield, aren't just looking at the backwards exclusively, but they're also thinking about what potentially could and might happen in the future. And I think, again, we need to do that as investors. We tend to be so focused on what happened in the past. So thank you, Tony, for doing that. Mike, you're up next. Break it down for us on performance and yield.
So yield's going to be far and away SCHD. I mean, it's got the most targeted component to actually achieve that. As a result, it has a much higher yield. So if you're looking for that qualified dividend income and something you can just get that cash flow out of, SCHD is going to provide a much higher yield in there too. They all yield nicely above the market though. So they all got a yield component. They've all got a great value tilt, which when I think of yield, I think value. It's generally one of your value factors in it. SCHD had a rough year last year, and it's kind of messed up its 1, 3, 5 year numbers. Historically, it's been a great strategy. I believe in it going forward, just like Tony does. But it does highlight what can happen with only reconstituting a portfolio once a year. Market dynamics can change very quickly and cause your screens to be very different one month to another. And you might end up screening something very differently. And you can really see it if you go and look at SCHD's rebalance. You can see it take huge haircut from tech on its last rebalance, a huge haircut in financials into a couple of other sectors. It may prove out to work out really well. The years got a long ways to go. So it still has great fundamental factors in there, but just something to keep in mind relative to like how these strategies work. If it is passive, the timing of those rebalances can make a big deal. There's been a couple of great articles written about rebalancing luck. When you do your rebalance, was it the right time to do it and how it can affect performance with these passive strategies? All said and done, looking forward, I still like SCHD, though I will tell you if you're looking for a core position, you want a core position maybe with a little lower volatility, a little higher yield. The SPDG, even though it's new, I would expect it's going to provide very closer returns to the S&P 500 because of that, the way it weights around the sectors. and get you a little bit more yield, a little bit more maybe quality slash value component, so growth at a reasonable price. So I like that. It's too young for me to really know what's happening there, so I'm going to stick with SCHD. And then DIVB is a great strategy, but I don't like the market cap weighting component of how they manage that strategy.
All right. Well, that takes us next to the mystery battle category, where our judges can pick a single or multiple factors that they think are important to today's contest. So, Mike, what is your mystery battle category, and which of these three ETFs wins it?
Yeah, so let's talk a little active passive. My mystery here is I think we have to recognize that I think as an industry, embrace the fact that some of the largest, most well-sourced investment firms out there like T. Rowe Price, John Hancock, are coming to market and embracing ETFs finally. Took them a while to get there, but they're coming in and they're embracing the lower cost structure, not as low as what you'd get from a pure passive strategy, but under 50 basis points. And if you apply a tax efficient active strategy with a lower expense ratio, I do believe it can provide consistency. Using that SCHD example, you have the ability to kind of massage your strategy based on macro environments, but you really can't do that with a pure passive strategy. So I would encourage investors, if you're looking for core allocations, don't completely shy away from the active front, because there are a lot of great managers coming to market here and providing very interesting strategies, very well researched strategies, for a very, in my opinion, a reasonable price, and you're getting it in the great ETF wrapper. So that's my mystery category. I'm not going to throw out a bunch of tickers, but it's not too hard to find them out there and take a look at that.
Well, I think that's the first time we've had active dividend ETFs chosen as a wild card, just the entire group. So great analysis, Mike. And you're right. We're getting more choices in the active dividend ETF space. This may even prompt some of our viewers to send us some ticker symbols for a future and potential ETF battle episode. So great job. Tony, you're up next. Your mystery battle category, what is it, and which of these ETFs wins it?
This is a term I coined myself called continuity. It's just like, can I rely on this ETF still delivering exposure to the same strategy later? And on the active side, this is a risk you got to look out for called style drift. You look at Fidelity Contra Fund. It started out as a contrarian fund, but it turned into large cap growth. To great effect, I might add. William Danoff has absolutely killed it. But you look at the name of the strategy, Contra Fund. It was originally supposed to be a contrarian fund. So back to this, SCHD is the only one I feel comfortable holding for 10 years. Partially because it's so massive. It's just got $70 billion in assets, and that's a lot of licensing fees being paid to S&P Global for the Dow Jones US Dividend 100. They're not going to change that index from them. They're going to keep using that, and that is the index that I want to be invested in if I'm owning this ETF. SPDG, I love the sector neutral approach. We've seen this to great effect with even ESG ETFs like S&PE, where they've managed to outperform the S&P 500 without those big sector deviations. But it's been around since September 2023, and it's tiny in size. I think it has like 9.85 million in AUM, so it's well below that 50 million death zone. And I honestly don't know how long this ETF is going to stay open for. Like the next strategic review at SSGA, they might just axe this thing because it's likely not turning a profit, especially with an expense ratio that low. And as for DIVB, just the constant changes to the index that it uses by Morningstar is just something that I'm just not a fan of. Like, I know that they're just trying to optimize it, but in my opinion, the whole point of an index ETF is to just really set it and forget it. And if I have to worry about how they're going to change the reconstitution criteria, the selection criteria, the weighting criteria, you might as well just go active at that point, right? And, DIVB isn't that big either. It's at less than $1 billion assets under management. It's not in danger of closing down, but, the iShares ETF lineup, and this is more of a meta thing, the iShares ETF lineup is freaking massive right now. They have so many funds and a lot of them are redundant. You already have two other core dividend ETFs, DGRO and HDV. I could definitely see a scenario one day where someone there takes a look at these three and decides DIVB can get axed and merged into the other two. And we've seen it happen before with other funds. They change their names, the share classes get merged, different funds get merged. So again, like just from a peace of mind perspective, I'm going to take SCHD for the long run.
Well, we've had some great analysis up until this point. Now we're going to give our judges a final opportunity with their final say. Tony, give it to us.
SCHD is one of those few dividend ETFs that I really like from both a total return and a factor perspective. The index methodology is multifaceted, it is rigorous, it is sound, and you're getting this for 6 basis points, which is an absolute steal, not steer. It's an absolute steal. And then one thing for those of you concerned about tax efficiency is that SCHD's index also excludes real estate investment trusts. So the majority of the dividends are going to be qualified. You don't have that ordinary income to worry about, unlike some dividend ETFs where, because they don't exclude real estate investment trusts, you get a big dose of them because a lot of those have high yields. If I had to pick a dividend ETF to stick to and understanding that I like total returns better, I would not mind owning this one.
Mike, your final chance to weigh in with your overall winner. Give it to us.
Yeah, I think we're gonna get an agreement today. It's unheard of. I feel like the last several of these I've been on, we've had split decisions, but SCHD is my winner, and I'll give you 3 reasons why. It is incredibly cheap and efficient to get access to these products. It has as Tony has done a much better job than I will try to repeat, so save everybody some time, a very fundamental, sound process to it. But number 3, and I got to be honest, it's truly the true dividend product of this battle. It's actually going after yield. It's a dividend strategy. The other 2, don't get me wrong, they're not dividend products. But this one is a legitimate yielder, yielding almost 4% on a weighted average base of the underlying. And hey, this is a dividend battle. So let's give it to the dividend ETF, SCHD.
Well, our judges have spoken. And according to my final battle scorecard, SCHD is the winner. To quote retired basketball player Rasheed Wallace, ball don't lie. And in this contest, the ball bounced in favor of SCHD overwhelmingly. Our judges agreed on exposure strategy, performance and yield, mystery, the overall battle winner, and they made some great points. I think one that stuck out to me is SCHD among this trio has the most fundamental screens. And for just 6 basis points annually, that's quite the bargain for dividend-focused ETF investors. Great job to both of our judges. Active dividend ETFs, Mike mentioned that as something that our audience should watch for. I don't know. Maybe we'll get some future requests for active dividend ETFs. Audience, do your homework and get back to me. Great job to both of our judges. We couldn't have done it without you.
Awesome. Thanks, John.
My pleasure.
Well, be sure to visit the description section below. We've got links to both of our judges to get in touch. We've also got a link to our program sponsor, Direction, who has been expanding their ETF lineup. We've also got lots of choices beyond industry sector ETFs, leveraged and inverse. We've also got single stock ETF, long and short. So be sure to check that out, as well as lots of freebies, free ebooks and other goodies. One final thing before we take off, which ETF battle would you like to see on our next episode? Hit me up in the comment section below or on our X feed at ETF Guide. Send me your ETF tickers and make it good. I'm Ron DeLegge. Thanks for watching today's contest. This is ETF Battles. We'll see you next time.